Market news now. Asian equities edged up higher, propped up by Hong Kong and China stocks, even as growing fears of an economic slowdown and worries over the pace of the Federal Reserve's interest rate hikes weighed on sentiment. Many in the market believe inflation is moderating and bond yields have peaked, allowing central banks to begin slowing rate hikes when policymakers from the Fed to the Bank of England and the European Central Bank meet next week. Locally, Tungela Resources, which is the coal miner that was spun off from Anglo American, expects its headline earnings to almost double when it releases its 2022 financial results. This comes as a result of higher coal prices and more demand for its product to meet energy demands in the partly because of the Ukrainian war. However, to talk to us about the market dynamics, we are joined by Patrice Rousseau, who's the Chief Investment Officer at Ashburton Investments. Patrice, thank you so much for your time. How are you characterizing the current global market sentiment right now?
Yes, good afternoon to your viewers. The global markets have pulled back somehow this week, oddly enough, on some strong data releases in the US, which led to concerns, as you mentioned, that the Federal Reserve would continue hiking interest rates. Already the market anticipating for this month the Fed to increase rates by 50 basis points. The bond market also indicating the high probability of a recession by the fact that the short-term rates are higher than the long-term rates. So the 2-year versus 10-year is what the market looks like. The inversion of the curve, meaning the short-term rates are higher than the longer-term rates, are at its widest since the 1980s. So I think the issue here is that there's still a lot of concern going forward, and the markets are looking for some reassurance from the Federal Reserve that they will not be too hawkish or hike interest rates too aggressively going forward.
So you have the China opening story where we've seen that welcomed by the market. At the back of your mind, are you concerned about any inflationary pressures coming through as we start seeing that wave of demand coming on from the China reopening?
Yes, that's a very good question, because we're weighing between the two. On the one side, we've seen that reopening trade, the MSCI China index being 30% in November in dollar terms. They've recently scrapped a number of COVID tests and quarantine areas. It seems that they've ditched their zero COVID policy, but as you mentioned, this means that demand for commodities is likely to increase in the already strained situation for supply, and that's likely to put pressure on cost-push inflation. On the other hand, though, I think that there is some pressure on inflation due to the fact that we've seen a slowdown, quite a sharp slowdown from Chinese exports. You see that in terms of the difficulty to get products from the likes of Apple. So maybe the reopening can also have a positive effect, negative in the sense of demand and pressure on basic raw materials, but on a finished goods basis. If China starts exporting again, we've seen its export fell to the lowest level in 2 years. That might ease some of the pressures in terms of supply chain and supplies that we've seen in the system.
Over the past couple of days, we've seen some of the U.S. banking CEOs sounding the call of, on a recession. How serious should we be heeding their warnings right now?
Yes, you rightly say the CEO of Goldman Sachs, David Solomon, and the CEO of JP Morgan, Jamie Dimon, talking about cracks in the consumer. I think that's a given. I think especially when you look at the developed world, where during COVID the consumer had accumulated excess savings, had received COVID grants. Now they're going in a net debt position. People are running down their credit cards to be able to make ends meet. Inflation is putting pressure. Unemployment is rising through retrenchment. I think what the CEO of Goldman Sachs was referring to more was the fact that there was a very buoyant investment banking environment, a lot of deals, and this is likely to slow down as the fears of recession accelerate. And he specifically mentioned that he believes there's only a 35% chance of a soft landing. There's almost a 100% chance of a recession, but the whole world is hoping for a soft landing.
When you look at, last week, Thursday, this time, the banking stocks were taking quite a big of a hit due to that Section 89 Phala Phala report. But outside of the political risks, what other risk are you seeing for the local banking sector?
Yes, as you say, the banking stocks tend to be really the bellwether of the economy because they land across economic sectors. But I think the key issue is interest rates in South Africa have increased quite substantially given the number of jumbo 75 basis point hikes. So we've had rates which were closer to 3.5% a year ago now at 7%. That's doubled. So that will put a lot of pressure on the average consumer who has floating rate debt, who has a mortgage, who has a car loan. You have GDP, which has rebounded somehow, but the problem is that a lot of businesses are still under pressure. So I don't think there is an ability for businesses to offer real wage growth. So with inflation being as high as it is in South Africa, I think wages are likely to lag behind, and companies are going to start to cut costs to be able to grow or maintain growth going forward. So I think the prognosis into next year is going to be very tough, just like we've spoken about the US. I think that would also be reflected in the South African economy.
Before I let you go, just quickly, what are you liking right now in the markets?
In the markets, I think we've seen a number of sectors under pressure. You mentioned the financials. I think the financials, which have done very well this year, they pull back. They're still trading, in some cases, at valuations which are equivalent to close to pre-COVID levels. Earnings are recovering. We still see some value in financials, despite the fact that it's tough right now. So I think this is where we position. I think the SA Inc. sectors are still very unloved. There's still a lot of fear in terms of what's happening in SA Inc., but the reality is the companies that have survived are thriving because there's less competition, they have cut costs, they are more resilient going forward, and valuations have corrected downwards. So we think there's a lot of very specific SA Inc. companies which are attractive to us at the moment.
Patrice, thank you so much for your time. That is Patrice Rasool, who is the Chief Investment Officer at Ashburton Investments. That is it from me. We're going to take a quick break. When we come back, we'll have more news for you, so stay tuned.